right, so we are going to start. This is business finance. Business finance. Business finance. Okay. And whenever the question is placed before you, or in attempting to answer the question, you must first read the requirement. Always read the requirement. So to start with, to read this requirement, we have required A, compute the payback period for each project, compute discounted payback period, calculate the net present value for both projects, calculate IRR, then the E, advantages of using discounted cash flow methods. All right, so we begin. XYZ Manufacturing Limited is evaluating two mutually exclusive projects, A and B. Both projects require an initial investment of 150,000. The expected annual cash inflows are as follows. Okay, so we have project A, 40,000, 50,000 cedis, 60,000, 50,000, 40,000. Project B, 60,000, 60,000, 50,000, 40,000, 30,000. The firm's cost of capital is 10%. Before we start, I have to explain some few concepts. This question, per the requirements, is under a topic called capital budgeting. Capital budgeting or investment appraisal. Investment appraisal. For you to undertake projects, they are all investments the business wants to, plunge its money into. Okay, and those projects mostly they are one-off kind of, or they require huge sums of money. Therefore, they are capital expenditure. So we have what is called a capital expenditure. In terms of expenditure, we have a revenue expenditure. We have capital expenditure. Revenue expenditure is for day-to-day operations. Day-to-day operations. So day-to-day operations. You spend money, or the business spends money on day-to-day operations, right? And then capital expenditure is on assets, non-current assets. Assets. Let me say specifically non-current assets, right? NCAs, non-current assets. So it can be tangible, they can be intangible. So when you spend those monies, they are quite huge and they are for substantial projects. So this question here is under capital budgeting or investment appraisal. When you are appraising an investment, it means, or a project, it means that you are evaluating the project to ascertain the feasibility thereof. So if the project is feasible, the business should plunge the money into it, should invest the money into it. If it's not feasible, they should reject it and go for a better option, which would give them a better ROI, that is return on investment. So some other concepts I will explain before we start the computation is what I would say are cash flows and inflows. Okay, what I would say are cash flows and inflows. So now we are talking about a cash flow. A cash flow literally means how cash flows in and out of the business. So if the cash flows in, or when the cash comes into the business, when the cash comes in, it is called an inflow because the money is flowing inside or into the business. When the cash goes out, It is called an outflow. Money is flowing out. So supposing I have a balance of 200 cedis and money flows in, and the amount of money which flows in is 100 cedis. How much will be my new balance?
300.
So when money flows in, it will be added. That'll give me 300 cedis. So what are we trying to say? Inflows add up. Inflows, they add up to balances. They will increase your balance. They will increase your income. They will increase your revenue. So inflows are positive figures. Outflows, money goes out. So again, I have a balance of the same 200. And then I owe you, or I owe another business 50 cedis. So when I pay the 50 cedis, how much will be my new balance?
150 cedis.
So the 50 cedis is less because I said payment. So I'll be left with 150 cedis. Now, an outflow is negative, meaning that whenever there is a cash outflow, that figure which is coming in is that figure which is going out is negative, like the 50 is negative. So it will reduce our balance. It will reduce our income. Inflows, they would increase our income. All right. Are you okay with this? I believe you are writing.
Yes, I am.
Okay. So let's proceed. Now, this out of the way before we start with the capital budgeting. We have what is called cash flow methods, right? We have what is called cash flow methods. So cash flow, I've explained what cash flows are. So we have cash flow methods. We have cash flow methods. Now, these cash flow methods, there are two. We have one and two. One, we have discounted cash flow methods. So discounted cash flow. CF is cash flow methods. And we have non-discounted cash flow methods. Non-discounted cash flow methods. Now, when we say discounted cash flow methods, examples of the methods are, we have the NPV, we have the discounted, let me start with discounted payback period. So this is discounted, right? Payback period. Payback period, that is DPBP, discounted payback period. We have the NPV, which is the net present value. We have the IRR. Sometimes you have what is called a profitability index. This profitability index has two formulas. So I'm talking about the one which will require present values. We have the profitability index, we have the NPV. We have Let me see. We have the MIRR. MIRR, modified internal rate of return. So this IRR, the first one is internal rate of return. Then we have the modified internal rate of return, which is a MIRR, MIRR. Okay. On the other side of the non-discounted cash flow methods, immediately I finish with this, we'll start the computation. So you need to understand the concepts. On the other side of the non-discounted cash flow methods, we have payback period. So you see this payback period, and we have the discounted payback period. This is the discounted payback period, and this payback period. Then we have the accounting rate of return, ARR, which is also sometimes called the average rate of return. And we have the return on capital employed, return on capital employed, which is the rules. Then we have the return on investments. Okay, so let me cover only these for the cash flow, non-discounted cash flow methods. So pay attention. When we say discounted cash flow methods, discounted cash flow methods, discounted cash flow methods. It means that there is going to be a certain cash flow. And don't forget what we said about the cash flow. It can be an inflow and an outflow. But that cash flow will be discounted. So when we say discounted, what does it mean? We go back to the future value, when you are the future value formula, which is under time value of money. So what is the formula for future value? Future value equals the present value into bracket 1 plus R exponent n. The future value equals the present value into bracket 1 plus R exponent n. Now, this future value, the concept is, if I have 200 today and I will invest it at a rate of 10%, so 10% is 0.1 into decimal fraction, right? That's 10%. It's 10%. And I'm going to invest this for 4 years. Use your calculator and tell me how much it will be. What is the future value? I have 200 cedis today, which is the present value. And then I'm going to invest this for 4 years at a rate of 10%. What will be the future value? Madam, quick. Hello?
I'm here. It's going to be
Yeah.
292.82.
So we are going to you have to make it very quick. 292.
Yes. 0.82.
Now, 0.82. Now you could see that my present value is 200. My present value is 200. That's the money I have now. When I go to the bank, invest with the bank for 4 years at a rate of 10%. So at the end of 4 years, this is going to be the value which I'm going to earn. This will be my future value. So you can see that whenever we use future value, we are finding a value which is higher in future than the present. The present value, the present figure is 200, and the future value is 292. Which item, which factor, which element made the 200 greater into the future to be 292.82? Which item made this 200 greater? It is this factor. And the name of this factor is called compounding factor. I'll be using it a lot. We've used it before, so I'm going to be using it a lot. Compounding factor. Compounding factor. So the compounding factor would make the money grow into the future. Now, so what is the formula for future value? It's equals the present value times the compounding factor. The compounding factor is the 1 plus r exponent n, which is at the top. Now, let's look at the opposite direction. If I want to find the present value, PV, I'll make it a subject. So the present value is, there must be a future value, and it will be multiplied by a certain factor. This factor, which the future value multiplies it by, please hold on. So just as we have for this, when I want to find the present value, equals the future value times 1 plus r negative n. So this 1 plus r negative n is called the discount factor. The discount factor. So now, to continue, the compounding factor makes the figure greater. A network. So the discount factor, let's assume that I want, right? I want to have 600 Ghana cedis or 620 Ghana cedis in future. That's the future value, right? And if I were to invest an amount, I don't know what the amount is now, and I invest but upon the investment, I'll earn 620 cedis in future at the rate of, let's say, 0.15 for 3 years. So there's a certain amount. I don't know what amount it is, but I want to have 620 Ghana cedis in future, right? At the rate of 0.15 for 3 years. What would be the present value? How much should I invest now? How much should I invest now? Yes, what should be the figure? Don't forget, it's negative 3.
Okay.
Let's be quick. How much will be the figure? So 620, bracket open, 1 plus 0.15, exponent negative 3. What do you have?
407.660661.
0.6467, right?
Yeah.
Okay. So it means that if I want to have 620 in future, the future value, at the rate of 15%, which is 0.15, exponent negative 3, the money I should invest now, which is the present value, should be 407.67. What it means is that whenever we use the discount factor, it will bring a future value down to a present value. So future values are always huge. Future values are like cash flows. Future values, they are like cash flows. And don't forget, we have 2 types of cash flows. You have the inflow, which adds up, and the outflow, which lessens or reduces. Yeah, we subtract. So the discount factor, the 1 plus r exponent n, negative n, which is this here, has caused the 620 to be reduced to 407. So always when you hear anything discount factor, it would bring a future value to the present. In other words, it will bring a higher value down to the present to make it smaller. Are you good? So look at the difference. Look at the two, the discount factor and the compounding factor. The discount factor and the compounding factor. What is the difference?
The negative n.
The negative n. On the number line, the negative n for the discount factor, on the number line, I'm explaining this because we're going to use it a lot through the calculation. On a number line, I have it to be 0. To the left of the number line, is it positive or negative?
Negative.
And to the right, positive. So the discount factor, which is the 1 plus r exponent negative n, what is its work? It reduces the value to the present, right? Like it will bring the value down. So when we had the 620, because of the negative sign of the n, it brought the value down. It subtracted the value, brought it down, right, to the present. But the compounding factor, which is the 1 plus r exponent n, will rather increase your value because positive is increasing, growing. So the compounding factor is to grow your money into the future. The discount factor is to reduce your money to the present. Why do we need to understand this? It comes back to what we started to do. That's the cash flow methods are two. We have the discounted cash flow methods and we have the non-discounted cash flow methods. And we wrote the NPV here. We wrote a discounted payback period. The discounted payback period. Discounted payback period. We wrote the IRR. We wrote the profitability index, the PI. We wrote the MIRR. All these methods, they should be discounted, meaning all these will use the discounted factor or the discount factor. All of them will use the discount factor because they said the cash flow, and don't forget, we said cash flow means that future values, right? So the cash flow will be using the discount factor, which is the 1 plus r exponent negative n. Now, it also means that all right. So we have the non-discounted cash flow. We have the payback period. We have the ARR. We have the ROS. We can have the ROI. These methods, cash flow methods, with the non-discounted, they do not use discount factor. That's why they are called non-discounted cash flows, meaning their cash flows are not discounted. You do not discount the cash flows. In other words, the discounted cash flow methods use time value of money. Time value of money. That is why they are using discount factor. They are factoring into the analysis how time could influence cash flows. But with the non-discounted, they do not consider anything like time value of money. That is why we don't have discount factor in their computation. So with these explanations out of the way, let us start with the computation. So now with the explanations out of the way, let's start with the computation. It says X, Y, and Z manufacturing method is evaluating two mutually exclusive projects, A and B. Both projects require an initial investment of 150,000. Good. So whenever we say initial investment, which is here, so initial investments, it is the same as what is called the capital outlay. And it is an outflow. Outflow because the supposition is that the money we are investing into the project, are you getting it? The money we are investing into the project is leaving the business's funds because it's going out to invest. So he is going out to invest. So long as it's going out from what we did earlier, it's an outflow. And as an outflow, it will be negative because it reduces our cash balance. All right. So require an initial investment of 150,000. So it means that this 150,000 will be negative. The expected annual cash inflows. So you could see these are cash inflows, meaning these monies are coming into the business. So there will be positive figures as follows. Project A. project B. So there are two projects, and the business wants to consider, or the business wants to ascertain which of these two projects they should undertake. In other words, which one of them is feasible, right? So let's put year at the top here. Then the first one, we'll make it year 1, year 2, year 3, year 4, year 5. Year 1, year 2, year 3, year 4, year 5. Okay, now let's start. So the first question says the firm's cost of capital. When we say cost of capital, it is rates. It is measured at 10%. All right. The cost of capital of the firm. So this cost of capital is to the firm. It is to the firm. But then this same cost of capital to the investor, it is called rate of return. To the investor, it is called rate of return. Because the investor is not considered about how much you spent. If he's going to invest into your business, it's not so much concerned about how much you spend to raise the money. What the investor is interested in is how much am I going to earn when I invest my money into your business, right? How much am I going to earn? But the business is interested in knowing how much it spends to come out with the process, with the valuation process and everything. That's the cost of capital. So the cost of capital, in other words, what I'm trying to say is that the cost of capital is the same as the rate of return. The cost of capital same as the rate of return. So when you see rate of return, it's not wrong because in that sense, they are giving that rate from the perspective or viewpoint of the investor. But here it says the cost of capital is 10%, meaning they are giving it from the viewpoint or perspective of the firm. That's XYZ Manufacturing Limited. All right. So the first question says we should compute the payback period for each project. So we go on. I write the name of the organization, which is XYZ Manufacturing Limited. 1. Payback period. Payback period. Payback period. Payback period. So I'll start with the year. The year. So this is project A. So I'm writing project A. Right? Then project B. In exams, you can do one below the other. You put, let's say, project A at the top, then project B below, or you can do it side by side. So project A, what do we have? We have the year. All of them will have years, right? So year, we have the cash flow, we have the payback period. The same applies to project B. Year, cash flow, payback period. So the year, we start from year 0, 1, 2. So from the question, how many years do we have? 5 years. 1, 2, 3, 4, and 5. The same applies to project B. Year 0, 1, 2, 3, 3, 4, 5. What are the cash flows from project A? 40, 50, 60, 50, 40. 40, 50, 60. 40, 50, 60. So 40, 50, 60, 50, 40. So 40,000, 50,000, 60,000, 50,000, 40,000. All right. Now, year zero will take the initial investments. And remember, the initial investments, I said, is an outflow, right? That's the 150,000 initial investments here. I'm using red font color here. That's the initial investment, 150,000. So I'm going to write it at the top, 150,000. And don't forget from the explanation, it's an outflow.
Okay.
So outflows are negative, and that's for year zero. Year zero, because from the projection of the business, they will start receiving, money will start coming into the business. They will start receiving revenue into the business at the start of year one. So year zero is when there was no activity, right? It's like their budget is like now, when they're about to start. If they should start, how much would they start with? Year zero. But they will start receiving revenues from year one. Those are the cash inflows. So the payback period is that we are going to pay. Now we owe 150,000. Okay. Let's work on project A first before we go and work on project B. So project A. So we have 150,000. So we're going to pay this 150,000 Ghana cedis, right? Don't forget the 150,000 cedis is negative 150,000. Negative 150,000. And for year one, how much are we going to receive at the end of year one? 40,000. So, and it's positive. So this is how you're going to do it on your calculator. Negative 150,000 plus 40,000. How much do we have? So compute on your calculator as I've done it. How much do we have? Come again?
110. 110,000.
That is wrong. Compute it well. Compute it as I have done it here. Just compute like this on your calculator and tell me what it is. What's the figure? What is the figure?
Negative
what?
110,000.
So what? Negative 110. If you want to work very quickly on your calculator, you want to work very, very quickly on your calculator. What is this? These values, these are 3 zeros, right? These are also 3 zeros. So on your calculator, when you are computing, because these have 3 zeros and these have 3 zeros, don't include the 3 zeros. Just make it negative 150 because you want to work with time quickly. Plus what? 40 because they all have zeros. You are going to have negative 110. Then you can bring your 3 zeros. Are you good?
Okay.
So you're going to have here to be negative 100. Don't write negative. Instead of writing negative, it means that it's still an outflow. So it is 110,000. Don't write it as negative 110. No, don't do this. The jacket shows it's negative. So you are doing an accounting. If we say that your revenue, right, is 50 and your cost of sale is 10. Cost of sale is an expense. So we less from revenue. We don't write negative and you write here as 40. We don't do this. This is not an accounting. what you must rather do is to put it in a bracket. Or you write less here, less without the brackets. Okay, you write here less without the brackets. That'll give you 40. This 40 is the gross profit. So this means you subtract from the 50. I hope you get it.
Okay. Yeah.
So what the interpretation is that at year zero, we are going to begin the business. We are going to invest 150,000. It's leaving the coffers of the business to go and invest. So after you invest it and you finish with the project, the first year of the project, you are going to have a revenue of 40,000. That 40,000, because you took 150,000 for the investment, you are going to work so much that you have to recoup, right, or recover or regain the 150,000. So the year one in revenue of 40,000, you would use it to offset part of the 150,000 you took out to invest. So let's assume the 150,000 you went for a loan, right? You went for a loan from a bank, or you contracted a loan from a bank or in the sum of 150,000 for the project. So that 150,000 for the project, right? And at the end of year one, you got 40,000. You use for the 40,000 to offset or defray a portion or proportion of your 150,000. In other words, to pay back the 150,000. So when you pay 40,000, you earn 40,000 at the end of year one, and you pay part of the 150,000. How much will you be left, or what will be the balance outstanding? That is 110. Because the 110, you are still owing. That's why it's in a jacket, because you've still not finished paying it.
Okay.
So year two, we have still. So the year one closing balance is 110,000. That will become the opening balance for year two. So year two, we are going to say 110,000. Don't bring the three zeros. Plus, remember the 50 is positive because an inflow. Plus 50. How much would that be?
Negative 60,000.
They're going to have negative 60. Then bring the three zeros because they all have three zeros. So don't write negative 60. Just put it in a bracket. 60,000.
Okay.
Now, look at year three. Year three, how much are we earning? How much are we going to earn?
You're going to earn 60,000.
Okay. Then if you are going to earn 60,000, how much do you also have outstanding to pay off?
60,000.
So at the end of year three, if you pay the 60,000, what will be our balance at the end of year three?
0.
So it's going to be negative 60 plus 60. Negative 60 plus what? 60, which will give us what? 0. So this would be dash. So the payback period is asking us how long? Payback period, payback period, payback period, pay back. What are you paying back? You owe something. You've gone for a loan. You've gone for money to do something. How long will it take you to pay back the money you came for? How long will it take you to pay back the money you came for?
3 years.
Right. Without time value of money. So what we would say, for us to easily get it, we say the payback period equals how many years did it take us to pay back fully the 150,000? It is 3 years. So year one, year two, year three. So 3 years. That's for project A. So for a confirmation, I'm using yellow. When we add this 60,000, we add a zero here to this 60,000, to this 50,000, to this 40,000. It should give us a 150,000. When we add the balance at the end of year three, which is 0, to the cash flow of 60,000, cut for year three, 50,000 for year two, and 40,000 for year one, it should give us a 150,000. So it means that we fully paid back the 450,000 in the third year. So it took us 3 years to pay off the money. So year one, the project A, it will take us 3 years to pay back. Let's go to year two. The same approach, the same concept. Let's go to year two. So let's look at the cash flows for year 2. We have 60, 60, 50, 40, 30. 60, 60, 50, 40, 30. That's the cash flow. So 60, 60, 60, 50, 40, 30. Right? So you're going to have here to be 60,000. 60,000, 50,000, 40,000, 30,000. The same outlay or investment amount, the same. Because from the question, they have the project costs or project financing budget to 150,000, and they're ascertaining whether they should go in for project A. Project A could be something like they want to construct 2-story building, and project B could be like we want to construct 3-story building. So with 150,000 Ghana cedis, what are we to? Which of the projects should we go into? Or project A could be they want to purchase a flat, and project B could be they want to purchase a land at the same amount, at the same contracted loan amount of 150,000. So with the same concept, we will say negative 150,000, negative 150,000, so 150 plus 60. Well, the 60 is the year 1 revenue, which is an inflow. How much would that give us?
Negative 90,000.
So negative 90,000. We write it in full. Then for year 2, negative 90,000 plus 60,000. How much would that give us?
Positive.
Negative, you have to, that's why I wrote it this way. You
Negative
have to do
30.
it.
Negative 30,000.
So negative 30,000. Negative 30,000. But look at the year 3. Year 3, you could see that we expect at the end of year 3 to have 50,000 Ghana cedis. But then the outflow, the money we have outstanding to pay is 30,000. So it means in year 3, the 30,000 which is left to pay is less than the 50,000 which will come in as revenue. Look at year 1. We paid 60,000, meaning year 1, the 150,000 was more than the 60,000 revenue we are going to have. So when we deduct it, we are going to have 30,000, 60,000, 90,000 at the end of year 1. And look at year 2 and year 1 balance. So year 1 balance was 90,000, which we owed, and year 2 revenue or inflow is 60,000. So the 90,000 we owed was more than the 60,000 in year 2. So we still had a balance of 30,000 owing, outstanding. By year 3, the 50,000 is more than the 30,000 we owe. So it will be the same computation. Minus 30 plus 50. What do we have?
20,000.
Positive or negative?
Positive 20,000.
So it's 20,000. Now the business is only interested in there. It doesn't mean the others are zero. If you wish, you can continue to work on them. Right? So we are going to have here. So the next one will be 20, which is positive, plus 40. I good for this for the year 3, which will give us what? Positive 60,000. So if you wish, you can continue with them. But then the next one, 60 plus 30,000 give us what? 90,000, which is positive. So what do we want to say? The payback period is simply concerned with when you pay back your loan. So in determining when we will pay back the loan, you could see that which years did we have negative values, negative balances, negative end of year balance?
The first and second year.
So that's 2 years. So it means we have 2 years here. I get it.
Yes.
We have 2 years here. So we have two. Let me put it this way. We have two. That's a 2 years. Okay. We are going to bring in or add. So the balance of 30,000, in which year did we pay it?
We paid it in the second year.
Hey. This thing is disturbing me. All right. So class, we need to continue. We have 90,000, 30,000. I'm using the project B. The screen went off, so I had to rewrite only the project B because we've done the project A. The project B, we have the 150,000. The cash flows per the question for project B are 60,000, 60,000, 50,000, 40,000, and 30,000. So we have it there. So now we've paid a proportion of our outflow, our outstanding debt obligation of 60,000 or 150,000. So we pay 60,000 of the 150,000. We have the balance of 90,000. And then year two revenue of 60,000 was used to pay the 90,000. We still have a balance outstanding of 30,000 indebtedness. So in year three, that's what we go to. We could see that the 30,000, which is the year two balance, is less than the 50,000 for year three. So what do we see? What we see is that we can pay the entire 30,000 in year three because the year three revenue is 50,000. So when we pay the entire 30,000 in year three, right, we are going to have a balance. That is, if you go by the usual computation of negative 30 plus 50, negative 30 plus 50, we are going to have 20,000 positive. So we can add a 20,000 to the 40,000, we get 60,000. And all these are positive cash flows now. 60,000 to 30,000, we are going to have 90,000. So these are actual revenues, right? These are incomes we are obtaining. Okay. So now the question is that what is the payback period? How long did it take us to pay back the full 150,000? So this could be a secret here. You will know that we paid the 30,000 in year three. All right. So the difference between the 50 and 20,000 here is the 30. If we add that 30 in year three, which we paid in year three, to the 60, and add that will give us 90. And add it to the 60 in year two, give us 90. Then to the 60 in year three, in year one, will give us the 150,000. So it means that it took us more than 2 years to pay back the loan or the amounts outstanding as the initial investment of the capital outlay. It took us more than 2 years. Also, another technique you can see is that which years gave us a negative closing balance, a negative closing balance. So year one, we got negative closing balance. Year two, we got negative closing balance. So we will write here as 2 years. So payback period is 2 years plus, okay, it's going to be 2 plus something years. So let me write it this way. 2 plus something all years. Now, what we are going to concern about is how long did it take us to pay? How long did it take us to pay the 30,000 in year three? Because the 50,000 in year three, which is the revenue, which is the inflow, is more than a 30,000 closing balance at the end of year two. It represents that we can pay the 30,000 within some months or within the 1 year. In other words, we can take some months in year three to pay back the 30,000, which we owe. And the remaining months in year three will give us a positive cash flow of 20,000, which will also become our income. All right. So how do we know? How do we determine the number of months in year three we took to pay the 30,000? So we would say we will pick the 30,000 as an absolute value. Here, take note that this 30,000 is negative. But because we want to find the number of months we used in year three to pay the 30,000, we will take the 30,000 as an absolute value. Absolute value means when it's negative, make it positive. So we will take it as an absolute value of 30,000 divided by the year three year 3 inflow of 50,000. Do you get it? Hey. How many years did it take the business to have negative values, as in pay the outstanding obligation of the 150,000? We have, it took year 1, year 2. Those are complete years. So we could say that as an evidence, we got negative at the end. Then balances at the end of the year were negative, meaning we're still owing. Are you getting it? So it's 2 years straight or 2 years exactly. But then the 30,000, the remaining 30,000 was paid in year 3, right? So we want to know how many months in year 3 did we take to pay the 30,000. So we would treat the 30,000 as an absolute figure. That is 30,000 divided by the inflow of 50,000 for year 3. And this is going to give us 30 divided by 50, which is 0.6. So we are going to have 2 plus 0.6, right, years. 2 plus 0.6 years, which will give us 2.6 years. Okay, that's going to give us 2.6 years. So 2.6 years. 2.6 years. All right. So it means that 2.6 years simply means 2 years, 6 months. All right. So it means in year 3, the business will take 6 months. Are you good? In year 3, considering the cash flow of the inflow of 50,000, in year 3, considering the inflow of 50,000, the business will take 6 months. Are you getting it? 6 months to pay back the 30,000, which is outstanding at the end of year 2. To take 6 months to pay the 30,000, which is outstanding at the end of year 2. Are you good? And then the remaining 6 months, the business will earn 20,000 in cash revenue, right? Which will not be used to offset any obligation. So that will be a full positive cash income. Are you getting it? So from the question, it means that in year, from the project A, which we solved, from the project A, I get from the project A, which we have solved. So projects, let me use PROG, project A, it took the business 3 years. From the project B, it took the business 2.6 years, or it took the firm 2.6 years. So these two, which one should the business undertake? These two projects, which one should the business undertake? Before you can determine which one the business will undertake, you have to look at first, you have to take the lower. Okay, first, you have to consider the fact that the business has projected 5 years to repay or to recoup its investments or to get back the money it has invested, the 50,000, or assuming the business has gone for a loan to pay back the loan amount 150,000 in 5 years. That was a projection. But then from the payback period, we realize one is 3 years for project A and project B is 2 years. So the lower of the number of years, that is the project which will be taken. The project with the lower number of years will be accepted. So here we would say that project B should be accepted. This is because it is 2.6 years less than 3 years, or it takes 2.6 years for project B less than 3 years for project A to pay back, right, the loan or to recoup its investments. So project B should be accepted because it takes 2.6 years, right, less than 3 years for project A to recoup its investments. So because there are two projects and they are mutually exclusive, we have to consider each of them separately, looking at the period to recoup the investment, and then considering the period which we will use to recoup the investment, we will pick the lower. In other words, the business will earn income, more income, right? For project B compared to project A. Because for project B, it will start earning, what's the name? It will start earning 20,000 from year 3. And if you could remember, when we did a project A, the business was earning, the business had the project A, if you could remember the project A, it was in year 3, we got 0 because there was a cash flow of 60,000. There was an inflow of 60,000. And that 60,000 was paying a balance. It was paying a debt balance of 60,000 from the project A. Are you getting it? So it was paying a debt balance of 60,000. So when we less the 60,000 debt obligation from the inflow of 60,000 for year 3, we got a 0 balance at the end of year 3. I'm explaining this because you can't tell how questions should be. So when you understand the concept, it's better. So 60,000 less, this is the project A. 60,000 less 60,000 gave us 0. So it means that from the same 150,000 is the initial investment or the capital outlay, project B will start earning income from year 3, 20,000. At the same time, if we are to invest in project A, it will not have any income in year 3. It will actually start earning income from year 4. Year 4. Meanwhile, in year 4, by the time project A will start earning income in year 4, right? Then by that time, project B has earned 60,000 revenue. 60,000 revenue. So this is 50,000 for project A. That's the cash flows. This is 40,000. So by the time project A would break even or would have 0 balance at the end of year 3, project B will be earning 20,000 in revenue. And when we get to year 4, project A, which has 50,000, will have an income of 50,000, but that will be 0 plus 50,000 give us 50,000. Meanwhile, project B would have earned 60,000. That's the 40,000 plus 60,000 will give us 80,000. So by the time we get to year 4, when project A would have started earning revenue of 50,000, project B would have had revenue of 80,000. It is more profitable to invest in project B. Then we add a 50,000 for project A to project B to the cash flow of 40,000. We have 90,000. That will be the other balance, closing balance at the end of year 5. Meanwhile, for project B, it will be 80. We add all these 3 together, which will become the balance at the end of year 5. So 80 plus 90 will give us 170,000. So you could see that it is more profitable to invest in project B because it will take the business 2.6 years, which is less than 3 years for the project A to recoup its investments. All good. So in exams, you are not to do all this detailed explanation. All that the business needs to get your payback period for each of the projects, and you comment. And your comment should be you consider the lower years, the project with the lower years to recoup the investment. So I only did this further explanation for us to understand the concept properly, right? For us to understand the concept properly. So here, when you finish writing the project A we saw, we got 3 years, project B, we got 2.6 years. You just write that the project should undertake project B. This is because it will take the business 2.6 years, less than the 3 years for project A, to recoup its investments. All right, so I will send the video for the next computation.